We're going to talk about the three major financial statements. This is a big part of business, just tracking what's going on. Income statement, balance sheet, and statement of cash flows. All three of them talk about different things. Your income statement is the revenue that you bring in, all the cash the organization brings in, minus all the expenses, and then finally what you have left over is your profit or your loss. That's why sometimes this has a nickname of the profit and loss statement or the P&L statement. So it tracks the same money that your balance sheet does, but in a totally different way. We refer to the income statement more as a movie of the last quarter as to what's going on in the organization, whereas the balance sheet is more like a snapshot of what's going on at that single moment in your organization, because the balance sheet, you want to count your assets, and the assets equal the liabilities plus what we call the owner's equity. And then the third statement is called the statement of cash flows. This is important for every organization, but much more so for a small organization, since there's so much less money than a big one would have. It becomes critical to make certain there's enough cash on hand to cover your operating costs, okay, and the investing and the financing that you have. So all three are critical. They all serve a different function. So that being said, here is what we call the fundamental accounting equation. Assets equal liabilities plus owner's equity. By the way, all the accounting people, they say you have to say it with that deep voice. This is like the ultimate equation in business. Assets equals liabilities plus owner's equity. I hear that some of the really top-notch accountants actually have this tattooed on their right deltoid muscle. Assets equal liabilities plus owner's equity. So, and this is also part of what we call the balance sheet. You look at the assets, liabilities, and owner's equity, and everybody has to have them. So you kind of look at the assets are the things that you own, and the liabilities are the things that you owe. And we have another account called owner's equity, which is really what's left over after the things that we owe in the process. So that being said, there's a couple of things to look at, and this is typically a polling question. We talk about an intangible asset. Tangible means something you can touch. Intangible means something you can't touch. So an intangible asset is like a copyright, a trademark, something that's intellectual property. A current asset is something that you can get rid of in 1 year, and a fixed asset is a large, either piece of capital equipment, like huge expensive machinery, or a building, something that you generally would liquidate more than a year, take longer to get rid of in the process. So you have different levels of the assets that all play a part in the balance sheet. Liquidity is about, can you convert it in a year? Fixed assets are permanent. Intangible are patents, trademarks, and so on. And your liabilities, you have three different categories as well. You have your current liabilities, owed to things that you owe but not yet have to pay for. And then notes payable are short-term or long-term liabilities, typically 1 to 3 years. And then bonds payable are longer term than that. It just depends on the length of the note or the length of the bond you should go through. The amount of money left over from the assets by the time you're done from the liabilities, that's called owner's equity. So it's assets minus liabilities equals owner's equity. Sometimes instead of distributing the money, the profit that you make, and that's called dividends, out to the shareholders, sometimes you keep the money in the organization and you hold on to it, or you reinvest it. That's called retained earnings. That you're retaining or keeping the earnings. So a lot of times you'll sit back there and reinvest it back into the company instead of sharing it with all the stockholders. So what do we call the formula for the balance sheet? You should know this down pat. Assets equal liabilities plus owner's equity. What does it mean to list assets according to liquidity? A year or less. The difference between long-term and short-term liabilities. Okay, long-term is long, like 3 years or more typically, and short-term is less than a year. And then what is owner equity? It's assets minus liabilities equals owner's equity. So that's test prep, just in case you need that. Always keep in mind that the balance sheet is a snapshot, and the fundamental accounting equation is assets equals liabilities plus owner's equity, and you have to say it like that. An asset are things that we own. A liability is something that we owe. Owner's equity is the amount of value in the company that the owners have once you sit down and remove all the liabilities. Liquidity is can you liquidate it in a year? Then we call it liquid, or it could be current in the process. And then retained earnings are earnings that we keep in the company. That's the basic beginning of financial statements. Take care.